Good evening. I am Amy Bach, and I am the executive director and the co-founder of the nonprofit called United Policyholders. At the heart of what United Policyholders' messages are through our Roadmap to Recovery program is this concept that you have paid for insurance protection and good claim service, that a lot of what we are recommending throughout the long-term recovery is that you need to be proactive, and as hard as that is, that really is the way to get back home. So thank you for being here, thank you for taking the time and putting in the work. We try to do the curriculum of the workshop series in the order of the issues that people typically are encountering along the 24 to 36 month recovery timeline. But when we get to this point, when we're at 18 months or so, people are in lots of different places. You know, some people are stuck over on their dwelling, or some people are stuck on their rebuild design, or they haven't been able to figure out how they're going to pay for their rebuild, etc. So tonight we are talking about financial decisions and income tax guidance for wildfire survivors. This is a generic topic that should be of use to everybody. For our next workshop, I have an idea of what I think we're going to do, but I am very interested in getting input from you guys. So again, if you have a topic that you would like us to cover, we welcome you to email us at info@uphelp.org, and we will take your suggestions into consideration. About United Policyholders, we're a nonprofit. That's our tax ID number. We've been around since 1991. We're a voice and an information resource for insurance consumers in all 50 states and the territories. We have a 26-plus year track record and subject matter expertise in insurance and disaster recovery. We're not for profit, not for sale. We don't take money from insurance companies, and we don't endorse any of the businesses that support us or speak at our workshops. They are volunteers. We are funded by donations and grants, and then we have an amazing volunteer corps who have a breadth of personal and professional expertise in disaster recovery, insurance, legal, construction, and personal finance matters. That is a screenshot of the homepage of our website, uphelp.org. We ran out of the handouts. I apologize for that, but you can very easily download it from our website at the uphelp.org/taxinfo, and I will make sure tomorrow to make it extra easy for you to find. But the tax tips handout is straight off of our website. You can look at videos. We've got Louis Ekram down here who's been videotaping all of these workshops and posting them up on our website. You just have to scroll down that landing page and you can watch them at your leisure. And then of course we have all kinds of sample letters and things on our site, as well as tips from past disaster survivors. This workshop is intended to be general guidance only, not legal advice. We don't endorse or warrant any of the sponsors or speakers. They're volunteering their time as educators. Tonight's speakers will be myself, a special guest, Dan Prince, who is a certified public account, CPA, with the Prince Accountancy Corporation. He lives in the North Bay, and he, just like Mike Musson, who spoke at our tax workshop last year, he himself lost his own home. So he has both personal and professional experience in the financial decisions you have all been grappling with and some of the guideposts for you to use to make those decisions. I also want to thank Catherine Payton, who is a CFP, that stands for Certified Financial Planner with Abacus Wealth Partners. Catherine is here to help answer your questions during the Q&A. Special thanks to the City of Santa Rosa, Sonoma County, the Foundation for Financial Planning, Community Foundation of Sonoma County, the Prince Accountancy Corporation, Catherine Payton with Abacus, Fred Booker, our fabulous, intrepid volunteer who's been at the check-in table at many of these workshops, again, lost his own home, Vida Iskander, who has been running and helping form some of the groups, the insurance groups, and doing hard work on block captain organizing. And then, of course, the staff, Andrew, with the Unitarian Universalist Church. And I also want to acknowledge my colleague Sandy Watts over there, who's going to be helping also during Q&A. If you are in the state of mind where you can even envision replanting at your lot, there is a free guide that was updated recently by the California Native Plant Society, and you can download that for free at www.cnps.org. And that's specifically research-based answers to common questions that homeowners face with their plants around the house. This is a reminder, if you are struggling with insurance issues and you have not been connected with other people who are insured with the same company you are insured with, you can access some of the groups by going to the neighborstogether.com website, and right along the top navigation bar it says insurance groups, and you can click on that and it will help you. A lot of folks are doing their little informal groups. Whatever works for you is fine, but it is a very effective, free way of boosting your leverage with your insurance company, is to be in touch with other people who are dealing with that same insurance company. You can share ideas, and as we were getting ready to start the program tonight, a couple folks who are insured with Safeco shared that one of them felt that she had gotten $50,000 more out of her adjuster just because she went back to the adjuster with information that she got from another Safeco policyholder. So again, it's a very useful way. It's, peer pressure is what it is. When the insurers know that the law is they have to treat everyone the same, and when you have proof that they're not, that can bring about a better outcome for you. So this has been a big week, obviously, with the PG&E bankruptcy filing, also the CAL FIRE report about the tub's origin not necessarily having been PG&E's fault, but again, those of you who are already in litigation, you should be talking to your lawyers and hearing their take on it. It's not a black and white situation. It doesn't mean the end of things. It's just a lot more complicated. Under insurance lawsuits, we are tracking them somewhat, we being United policyholders. We know of one against USAA. These are group suits on behalf of people who are underinsured with USAA. There is at least 2 group suits that have been filed on behalf of underinsured people who are with farmers, one of them by a law firm in Southern California, one of them by a law firm in San Francisco. Then there is a lawsuit that's been brought on behalf of State Farm underinsured policyholders by a local attorney here. We provide a lot of information on our website about underinsurance. Because I'm an attorney and because I've been running this program for a long time, underinsurance is sort of the toughest nut. So we are continuing to do everything we can as an organization to increase your chances of getting a fair outcome, and basically changing the law so it reflects the reality that you all have relied, almost every one of you relied on an insurance professional to set your limits, and it wasn't a decision that you made. And we know that that is the reality, but the courts don't see it that way. But that's a work in progress. So if you are now thinking even more that you might want to join a suit because you're underinsured and you're discouraged about your prospects of making up your gap through PG&E, then I would recommend you spend a little time on our website. You put the word underinsurance in the search box, and we've got a couple of the lawsuits up there. We've got a lot of information just for you to digest. So the bottom line is, it is an option, and we have information to help you make that decision. We are funded here through the 2nd anniversary of your fire, which means, again, we're looking, not only are we going to be doing another survey to take your temperature on where everybody is, but also we want to know what kind of more support you want from us, and that's why I invite you to email workshop topic requests to info@uphelp.org. Thank you to those of you who made the trek up to Chico to sit at our table. That just blew our minds, and it's very We never would ask people who are where you all are in the process to put yourselves back in that very intense situation, but some people wanted to, so we're very grateful for that. What are some of the common personal finance questions? I want to collect every available dollar of my insurance. Am I better off replacing my home by rebuilding or buying? It's a very common question. If I rebuild, what size home makes the most sense? How does this catastrophe impact my retirement, my budget, my money I put away for college for my kids, future plans? I'm underinsured. This is a very common question. What are my options for financing reconstruction costs above my insurance limits? If I replace with a cheaper or smaller home, what happens to my property value? So I'm just going to do a quick recap of our basic approach to the questions on that list that we can answer. Most of them are questions that professionals can help you with. What's the speak up recap? Figure out what it would cost, in theory, to replace your former home with one of like kind and quality in compliance with building codes. That dollar amount will help you, number one, know the full value of your losses and the extent to which you are either underinsured or properly insured. Project what you can spend to replace your home if you are only using insurance funds. And three, confer with a tax professional who has casualty loss experience and be able to tell them what your financial picture is in the aftermath of the catastrophe. So how do you do that? You need to get somebody to scope and estimate replacing as was and to code, so that document we've been talking about, a scope of loss. Or if you have a builder who's given you a real traditional bid that has subcontractor estimates to support it for replacing that home, that's just as good. Do your best to negotiate a claim settlement that includes your max A and all extensions and available coverages that can be applied toward your dwelling replacement. And if you can't get to an agreement with your insurer over the value, the replacement value of the dwelling you lost, then you can try mediation, you can try a request for assistance with the Department of Insurance, and you can try litigation, and you can try public relations pressure. And that's that sharing information with your neighbors, talking to the media, writing letters to the editor. Again, there's two things that insurance companies really don't like. They don't like bad press, and they don't like big jury verdicts. So those are things that get them to really pay attention. Thinking outside of the box to resettle, group rebuilding is an option for some people in some areas where you can find some economies of scale that can help you rebuild by getting together with neighbors and hiring a builder together. And instead of them having 6 different trucks, they'll have one truck, and then they can go from house to house. And then there's some cost savings that can be realized there. Manufactured or tech-built homes have come a long way, and there's a lot of interesting options there. Fire-resistant materials, if you can incorporate that into your rebuild, that can help you down the road with keeping insurance after you've rebuilt. And I just always like to throw this in there. Time is money, and leaving some insurance money on the table to move forward is not a sin. So I know that a lot of what we're here talking about is how you get every dollar, but again, in my years of doing this, it isn't. This is not a competition or a race. This is really your own path, and so just don't get so blinded by the drive to get every dollar that you lose the forest for the trees. If there is an option that's going to get you around all this stress, and you might leave some ALE on the table, that is not the end of the world. That's I know it's easy for me to say, but I do like to throw that out there for your consideration. What are some of the common tax questions that our guest speaker is going to address? Are some or all of my insurance proceeds taxable? If I'm underinsured in one or more categories, can I offset those losses on my return? What about litigation settlement proceeds? If I get some money in settlement of a case that I'm a plaintiff in, is that taxable? What tax considerations are there if I sell my lot without rebuilding? That's probably one of the most often asked questions in these parts. What are some of the professional experts that can help you answer these questions? Well, a rebuild cost estimator can help you with that scope if you're still struggling to get to that. What's the value of your loss on the dwelling, right? You can also get professional help with personal property valuation. And a lot of you, your insurance companies have been sending different types of professionals to help you. Some people are getting personal property folks to come and help them. And it doesn't, not to say that those people are always not to be trusted and always trying to rip you off. I would never say that. I would just say that, if on the big ticket items, make sure that you get independent valuations. There's nothing wrong with working cooperatively with your insurance adjuster to the extent that you can. That's fine. And that same goes for their dwelling replacement. If they've made you an offer and they've given you documentation, you don't have to just throw it out of the window as useless because it came from the insurance company, right? I would never say that, and I don't think if somebody said that to you, it would be very good advice. This is all a matter of trusting but verifying and getting valuation estimates that you feel are accurate. Wealth advisors, they work on two fee bases. They either charge a percentage of assets under management, or they charge commission on products they may sell you, or they charge a flat fee for their services. I know Catherine can answer questions about that. Realtors can be a great source of free information on valuing your former home, and of course the home that you might, if you're thinking about replacing by buying, getting the documentation that you need to give your insurer there. Attorneys, of course, what we call policyholder attorneys, those are my people. Those are the people that are not, they wouldn't call themselves personal injury lawyers. It's a very small number of lawyers. It's just lawyers that day in and day out specialize in representing insurance consumers, people like you, in disputes, and that's their specialty. And those are always my first choice if you're looking for an attorney in a situation like this. Personal injury attorneys, of course, those are most of the firms that are doing the suits against PG&E. I would categorize them as personal injury attorneys. And then, of course, construction attorneys. And hopefully you're not going to need one of those because you're going thoughtfully into the process of rebuilding. Mortgage brokers, probably not something you're going to need at this juncture. And then, of course, construction lending professionals. And I personally think a CPA who has casualty tax prep experience is golden, valuable, especially one who actually lost their home, which is why we are bringing you Dan Prince. Again, I already gave you a little bit of info about Dan, but he is a resident of this area and is bringing you both personal and professional expertise.
Okay, unfortunately, normally they save the best speaker for last, but I really believe, and on my summary page, the best speaker has hit. We're going downhill from here. But I think tax is just a small component of what we need to pay attention to. The important areas have been addressed earlier, but we'll talk about tax. Regardless of what we get, by statute, it's not income. So you're claiming, or the insurance company cuts you a check for $300,000, who knows what your basis is? You have no documentation. There is no income recognition, ignore it. It just doesn't exist. Now, the interesting thing, and I think a lot of us are thinking, well, maybe we can claim a casualty loss on the personal property side. It's easy to think about. It's difficult to do. As a, for instance, IRS position, they've adopted what they call a safe harbor. That's the IRS way of saying, if you follow this pattern, we're not going to challenge it. Now the pattern is this. Determine current fair market value and reduce by 10% for each year the property is owned. You bought a widget. The current cost of that is $100. You've owned that widget for 9 years. Now, for purposes of computing the casualty loss, that widget is worth $10. Now, how many of you have filled out I call it the Excel spreadsheets for personal property? Have many of you done that? Exactly. Now, go back to those worksheets and apply that standard. I think, again, what I found with myself and with the clients is that there was extreme reluctance to fill out those worksheets. One, it was emotionally challenging, and it was a pain in the butt. Do we want to go back through and do that? I'm not trying to discourage you from claiming personal casualty losses. All I'm suggesting is applying that standard is almost guaranteed not to generate a meaningful loss. The case cited below is a tax court case, and what that is telling us is that IRS, or the tax court, allowed use of the insurance company's depreciation method in defining the casualty loss. We'll talk about what a casualty loss is in a second. I'm not trying to pry. How many of us have claimed casualty losses on personal property? Okay, and that's my expectation. There aren't that many of us doing it because the documentation is so difficult. As of October 9th, 2017, when the fire went through, for tax purposes, you've sold the property. So we have access to our 250 single 500,000 exclusion, code section 121. It's as if we were selling the house. So if we've got gain recognition, we can use that exclusion. If we have a loss, I asked for a show of hands on personal. How many of us have claimed a casualty loss on real property?
Or intend to?
There you go. Again, my expectation is, I do a lot of tax returns. So far, I've seen one. In this case, in this example, this was an extreme example. Actually, I've got two. I get a call from a client, and the client starts off with something like this. I thought the homeowners association was carrying the insurance on the property. Exactly. He lost the structure. He has no insurance. He is entitled to a casualty loss. But for most of us, we've purchased the real property. Years ago, a long time ago, I bought my house for $93,000. I put a lot of improvements in it, but I just don't have a loss. So if we can generate a loss, it will be carried back. It'll be treated as a net operating loss. We can carry it back 3 years federal, 2 years state. The example I was citing a second ago, it's a very unusual fact pattern. We don't want to do this. Husband and wife, husband passed shortly before the fires. At that point, we get a step up in tax basis for personal property and real property. For me, that was an easy fact pattern. I had documentation on the personal property, documentation on the real property. We claimed losses. We carried the losses back federal, 3 years, 2 years on state. But extraordinary situation. But again, I'm not trying to discourage you from claiming losses. My position is it's just difficult to do. ALE, again, before this point, how many of us knew what ALE was? We've learned much more from this. Again, insurance reimbursements for ALE, unless you tell me it's excessive and we're pocketing cash hand over fist, not an issue, not reportable as income. I don't have many clients that this applies to, but some it does. For business, if we have business interruption insurance coverage, one client has gotten over $300,000 of insurance recovery. Is that reportable as income? You bet. Dollar for dollar, it's got to be reported. Okay, a personal casualty loss is the smaller of cost of the property, what you paid for the property, reduced by insurance reimbursement, or decline in fair market value using the before and after casualty reduced by insurance. Earlier, we were touching upon personal casualty, how the IRS was determining the 10% reduction for each year the property is owned. That falls into the second category. The casualty loss is the smaller of. Again, it just makes it very difficult to claim a personal casualty loss. This is just a brief schedule of a computation of basis. So basically what we paid for the property, less insurance received, plus repairs, to come up with a basis after the casualty. This one, I like this one. I pulled this off of an IRS publication, Frequently Asked Questions for Disaster Victims. You can read that through, but basically what it's saying is, and this is my experience in dealing with IRS audits. One, we start the audit, we try to establish a rapport with the agent, we present things in good faith, we try to provide a reasonable basis. How many of us have documentation from the house fire? I have no documentation. The adjuster would look at me and he would say, okay, show me a picture of the house. And I would tell him each time, I don't have anything. Everything is gone. Then he went to Google Earth and he said, I'll get a picture. And it was cute. He couldn't get a picture because my particular house was covered in trees. I mean, there was nothing. So this, I think, is the IRS saying, work with us. IRS does not want to necessarily negate, turn down our casualty loss claims. All they're saying is, guys, meet us halfway. Give us something. I truly don't know what would satisfy this standard. We have no documentation. I think with planning for this casualty loss, we need to look at the totality. If we have a business, if we're going to generate a loss, what's our result? I'm back to the earlier planning issues. If I've got a rental, it's destroyed, do I have the ability to free up some suspended passive losses? I think we need to look at the total picture. So what I'm saying is, and I think this is with a number of us, I get a call from a client that used to live in Fountain Grove. They're not rebuilding. They're elderly. In fact, since the fires, one of the spouses has passed. They're not coming back. So we can use code section 121 and 1033. 121 is my 250, 500,000 exclusion. 1033 is basically saying, okay, I'm giving you XYZ dollars and I'm choosing to reinvest all of it. If that's our scenario, we'll have no gain recognition. So if we have insurance proceeds, I've got a married filing joint couple, 500,000 exclusion on sale. If I reinvest 300,000, I'm good. I have no gain recognition. Now, for those of us reporting casualty losses, again, we had two options. One is done, i.e., we had the ability to amend 2016 and report the loss in that year. Or two, we report the loss in the year the casualty occurred, i.e. 2017. So my assumption is at this point, short of filing amended returns, we're done in terms of reporting casualty losses. We can go back and file amendments 3 years from point of filing, so it's still in play. But personally, I think that's bad presentation. What we would have wanted to do was claim the loss in 17 on an original return. An amended return attracts more attention, subject to more scrutiny, but that's water under the bridge. If there is a gain recognized, it must be reported in the year of receipt of the insurance proceeds. I'll just mention this real quick. Again, if we're in a business setting, the business burns down, we get a 40% credit for each employee up to $6,000 of wages. If this applies to you, this can be a very meaningful credit. Okay, our timing. Go back to Fountain Grove. Couple is not coming back. They don't know what they're doing. Spouse is deceased. For business property, we've got 2 years following the year of receipt creating realized gain. Presumably that would be calendar year 2018. Or we have 4 years for a primary residence. The vast majority of us here are dealing with primary residences. So we've got 4 years to decide what we're going to do. I'm a big fan of disclosure. So when I prepare a return, whatever I'm doing, if it has any issues, I think our best defense is an offense, i.e., we're going to disclose on the return, oh, by the way, I was a victim of the XYZ fires, and we're going to say, for me, Nunn's fire, for you, Tubbs, whatever it is, we're going to have a description of the property, date we acquired it, what our basis is in the property. We're going to give them everything here. We've got nothing to hide. So if anybody looks at that return, they're going to understand we're a fire victim. And I think the IRS, again, my perception is, in this type of situation, IRS will try to work with us. They're not going to violate any policies, but if they give us the benefit of the doubt, that's not bad. Okay, back to my Fountain Grove couple. The house is destroyed. They've got a lot. And I know most of us read the article, what was it, in the Press Democrat last Sunday, or the lot sales, the very extensive article on lot sales. So the market is glutted. It's a buyer's market for lot sales. So the issue is, do we hold on to the lot, wait for appreciation, or we sell now? We are going to get our exclusion, 250,000, 500,000, Code Section 121. We get to use that exclusion every 24 months, every 2 years. We're also subject to deferral under Code Section 1033. I sell my lot for 250,000. As long as I'm within my 4-year period, I reinvest into another lot. That will avoid the gain recognition on the lot sale. But again, I don't have the answer for this. This is our realtor friends. Does it make sense to sell the lot at this time, or does it make more sense to hold on to the lot and wait for the market to correct? And how long is that going to take? And are we going to have appreciation on that lot? I mean, those are the great questions. Subsequent lawsuit settlements. So let's say down the road, hopefully, we get some type of activity from the various litigation that's out there. For tax purposes, we treat that as we would insurance recovery. I put a notation, cause of action. Obviously, it depends upon the cause of action. I'm an accountant, I'm not an attorney. Cause of action is, what's the complaint? Wrongful death, personal injury. In general, barring wrongful death, personal injury, I think more likely than not, these recoveries will be reportable as income. Please define your objectives and the path forward. While tax, property, and income are a factor in the decision-making process, it is not the most important. What's the most important is, do I want to live here? I had a gentleman come up to me the other day. This is great. He was in the Mark West area, and what he said is he started the rebuilding process. He got his permit. Then he sat down and decided he just didn't want to live there anymore. They purchased a house somewhere else. But again, it's, I want to live in this neighborhood, I don't. How do I, this is your area, but some of the insurance companies, they're telling the customer, we're not going to provide, for example, code upgrades, or we're not going to provide this part of the settlement unless you actually rebuild. And I'll defer to the attorneys and whatnot, but you really have to think this through. There's a lot of time and energy that's going to go into this process. The tax part is a small component. The bigger component is what's been touched upon earlier. I'm going to go through these quickly. If I think that the insurance proceeds I receive from my contents personal property is less than the value of the personal property destroyed in the fire, I want to report it as a loss. Do I have to do an inventory? Yes. We've got to give some documentation to taxing authority. If I've already filed my income taxes for 2017 but didn't claim the loss, is it too late? No. We've got 3 years to amend. And why do we want to claim the loss? We want to reduce our taxes. We want to save money, generate a net operating loss. If I think the insurance proceeds I receive from my dwelling is less than the value of my home destroyed by fire or less than the cost to rebuild and I want to report it as loss, what do I need to know and do? I think we need to know the cost basis. We need to know what you paid for the house. We need to know every dollar of improvements going in. We need to see the statement of loss from the insurance company. We need to know what you received from the insurance company allocable to the real property. Coverage A was XYZ dollars, code upgrade, ABC dollars, trees, scheduled personal property, all of that's going to go into the computation. The role of the appraiser is critical, and I have not done a lot of this, but I'm going to guess getting an appraisal pre-fire is going to be challenging. I am rebuilding, it is costing a fortune. I couldn't possibly have a gain, do I? And I think in general the answer is probably not. But again, we need to get our numbers together. What's our basis? What's our improvements? What are our insurance settlements by category? What are our rebuild costs? It's computational, it's formulaic. I think that'll do it for me. What I can provide, if it's helpful, is the formulas that are going to be used. They're not that straightforward. So if that's helpful, I can have that posted to the website. It's a pleasure talking to you.
Thanks very much.